What's going on, everyone, and welcome to my free investing webinar. I am so honored and so humbled that you decided to invest your next 30 minutes with me, and I promise it will be a wonderful investment on your part. My name is Patrick Venn, and I am a money coach and the creator of the Personal Finance Bodyguard program, a one-on-one program designed to help you master your money, invest with purpose, and crush your financial goals within just 12 weeks. To learn more about the one-on-one coaching program, head on over to patrickvenn.com. You can see more about the tools, systems, and resources you'll have lifetime access to in order to stay financially fit forever. Consider me kind of like a personal trainer, but for your wallet instead of your weight. Money is one of the main resources that we use to build and construct our lives. So if you want to build your dream life, we need to be really intentional with the way that we're putting our money to work. A lot of people have the saving side of their finances under control. They know how to be a good saver. Taking the leap into actually investing and learning to grow your money safely is something that people struggle with. So that is exactly what this webinar is designed to do. I'm going to share with you 3 secrets that have helped me become a very confident and resilient investor. Now, I have joined countless webinars in the past. Most of them are structured pretty much the exact same way. It's like a 45-minute to an hour-long sales pitch. I wanted to do something different. So I've condensed it down and packed in as much value as is humanly possible that you can use tomorrow. In the end, I do mention my one-on-one coaching program, but I give you the value, the information you can use upfront, regardless if you join my one-on-one coaching program or not. So, what are we actually going to cover in this webinar in a bit more detail? We're going to do 3 things. Number 1, I'm going to tell you my story, why I am sitting here in front of you on the computer screen talking about finances and investing. I'll include the most embarrassing story of my life as well. What better way to get to know a bunch of strangers on the internet than tell your most embarrassing story? But what the heck, we're going to give it a go. The second thing, the meat of this webinar, is going to be the 3 secrets every investor needs to know and how you can become a resilient investor. These secrets have helped me save not only countless time and energy, it's saved me hundreds of thousands of pounds in my lifetime, and I know that they can do the same for you. Finally, I'm going to show you how you can actually use those secrets to build your rich life, build your dream life, whatever that means to you. I'm going to show you the power of these 3 secrets. I'm very keen not to waste your time. It is very, very valuable. So let's check in just to make sure that you are in the right place. You are in the right place if you want to learn to build long-term wealth. If you want some overnight get-rich-quick scheme, I am not your guy. If you want to learn how to be a millionaire in your lifetime, perfect. You are in the right place. Stick around. Up next, you're not sure how to start investing. Maybe you're a little bit overwhelmed. Personal finance and investing, a lot like the fitness world. Everyone's got an opinion. There's so much information out there, it can be overwhelming. We're going to sort of sift through that. I'm going to cut through all the noise and give you the 3 most important things about investing that you need to know to get going tomorrow. You are in the right place if you believe investing is risky, confusing, or scary. Guess what? Everyone thinks that. I thought that before I knew all this stuff as well. So it is completely normal to feel that way. We're going to help you overcome that through education and knowledge. Finally, you want to get your money working hard for you. You are tired of that 0.1% return on your savings account. You know there's a better way to grow your money. You're just not exactly sure how to take those first steps or what to do. You are absolutely in the right place. On the flip side, you are in the wrong place if you are looking for any type of get-rich-quick scheme. If you want to become a millionaire overnight, as I say, go on Instagram, look at the crypto traders or the Forex currency traders telling you they're going to make you a millionaire overnight on a beach in Dubai. They're probably a better fit for you. You're in the wrong place if you want guaranteed positive returns every single year. Investing inherently comes with a few risks. I'm going to show you how you can sort of limit them or reduce them, but we will never eliminate them. There is always risk that you will lose money some years. If you can't handle that, keep your money in a 0.1% savings interest rate account. You are in the wrong place if you have a significant amount of consumer debt. Please, people, if you have, don't worry about your mortgage, but if you have credit card debt, student loans, lines of credit, high interest loans, tackle those first before you start investing. Once you've tackled those, revisit this webinar. I would love to have you back. And finally, if you want FCA regulated financial advice, I said from the top, I am a money coach. I am not an accredited financial advisor. I focus more on education and empowering you to make your own decisions versus telling you exactly what to buy or exactly what to do. Even after you complete this webinar, you're still going to need to take it upon yourself to do your research, but I'm hoping that I can jumpstart, give you a bit of a head start into investing and some big things that you want to avoid. If you want these slides to the 3 secrets every single investor needs to know, you can absolutely do that. You would have got to this webinar one of 2 ways. The first way is you signed up for it. If you did, fantastic. Just revisit the same email where you saw the link to this webinar. You'll also see a link to these slides as well. You may have also got to this video, maybe you stumbled upon it on YouTube or a friend sent it your way or something like that. If that's the case, no problem. Just click the link below this video and you can open up and download and follow along these slides with me. You'll have them in your computer forever. Please go ahead, pause the video now if you need to. Now I want to give you a 90-second story, a little bit of insight into me. 5 years ago, I wasn't good at this money stuff. I was actually pretty terrible. I had $10,000 in student and credit card debt, no savings, and certainly no investments at all to speak of. In the most embarrassing day of my life, we were on our way to one of my best friend's weddings. I was with a brand new girlfriend at the time, and she said we should stop at the ATM, take out some cash to give to my mate as a wedding gift. It was a few days away from payday, and I didn't have that much money in my bank account. I was strapped. I was broke. She said, no problem. Just take a little bit from your savings and replace it in a few days once you get paid. My response? What savings? It was at that point her eyes like bugged out of her head. Her jaw hit the floor kind of like in a cartoon. She was shocked at my financial situation. She ended up loaning me the £100 and I gave it to my friend. She was nice enough not to charge interest on that loan. And I paid her back, and it was just such an embarrassing experience in my life. That was the catalyst, the moment that made me start taking education about finances seriously and go about reversing my own financial situation. Fast forward 5 years, the debt is gone, the savings are strong, the investments are regular and well on the path to financial freedom. All of the information that you're going to learn in this webinar, I had to learn as well, and it has completely transformed my life. But it's not only transformed my life, it's transformed clients that I have worked with as well. Meet Harrison, a pro footballer here in the UK. Before working together, not investing at all. After he learned these 3 secrets that I'm about to teach you and working one-on-one with me, he actually gained the confidence to start investing his money and planning out his financial future. Awesome. Mikey, a physiotherapist, over a very, very short space of time, just 6 sessions, we reshifted his focus from just simply saving to actually giving him the confidence to start investing for the future. He says, thank you for the truly powerful gems of knowledge. I'm excited to start putting them into practice. This is what you're going to learn in the webinar, these 3 gems that will help you get going as well. And finally, there's Liam, another pro footballer here in the UK. I work with a lot of pro athletes. He actually gained an interest in investing and became financially stronger and improved his future life after working one-on-one together, learning these 3 secrets and putting them into practice. Future's not only a lot brighter, but also a lot greener as well. So really paying attention, getting intentional about your money and this investing stuff can absolutely change your financial future. I'm so excited to dive into the 3 secrets. I want to take 60 seconds just to explain 3 technical terms that we need to know in order to get through these 3 secrets. Some of you may know this already, but I want to make sure that everyone is on the same page. So first up, stocks. If you own a stock or a share of a company, you are part owner in that company. In a very simplistic way, if the company's doing well, share price is going up, you are probably making money. The opposite can happen. If the company's doing poorly, share price goes down, you stand to lose money. Next up, there is an index or a stock market index. This tracks the performance of a group of companies. You have no doubt heard about stock market index before. There's thousands of them around the world, but some of the more famous ones in the US, there's the S&P 500, which tracks the performance of the 500 largest traded companies in America. Think Facebook, Twitter, Amazon, Coca-Cola, things like that. And then here in the UK where I live, the FTSE 100 tracks the performance of the 100 largest companies here in the UK. Barclays, Tesco, NatWest, those type of brands. When people say the market is up 10% or the market is down 10%, they're usually referring to the largest stock market index in the country. It's just a good barometer for how the economy or the market as a whole is doing. As individual investors, we are actually allowed to own index funds, which is a fund that tries to replicate the performance or return of a particular index. So let's use that same example. You as an individual investor can buy an S&P 500 index fund, and the goal of that fund would be to mirror the performance of the S&P 500. The S&P 500 goes up 10%, your index fund will mirror that and go up 10%. If it goes down 10%, the S&P 500, your index fund will also mirror that and go down 10%. Another great way to think about it is if you're invested in an S&P 500 index, you own a tiny sliver of all the companies traded within the index. All right, let's kick off with the most important secret when it comes to investing. I'm going to start with the most important, and that is fees destroy your wealth. This is so important, I'm going to say it again. Fees destroy your wealth. Now, there are all kinds of different fees that you're charged for investing. Investing is not a free sport. We all have to pay some type of fees. These fees are sometimes so small that they seem insignificant to the untrained eye. But these small fees have an incredible ability to destroy your money over time. So let's go through some quick examples of the most common fees that you're likely to come across. This is not an exhaustive list, but these are some common ones. So there is platform fees for you just to have an investing account, like having a bank account. There's management fees. Maybe you have someone managing your investments for you. That costs a bit of money. There's also a fee depending on which fund that you invest in. There's always a cost per fund. Commission fees, there's performance fees. Sometimes if your portfolio is performing exceptionally well and someone's managing it for you, there might be a little bonus that they give themselves. And also advice fees. So to have someone there that you can contact all the time to give you professional guidance, investing advice, that will also cost you a fee. So let me walk you through an example of how fees can destroy your wealth. This is a typical example. 100 grand invested over 30 years, and it's just going based on a 9% annual return. Just for this example. Let's look at the difference between 0 fees, 1%, 2%, and 3%. So the first column there in all blue, we can see 100 grand invested over 30 years at 9% return. You would be a millionaire. 1.4 million. Not bad. 0 lost to fees. This is slightly misleading. As I said, there's always going to be some cost. For example, I pay 0.1% in fees. So it's not quite that 0 will be lost to fees, but the vast majority of your wealth is intact and not lost to fees. Great. Let's move over one column to 1% fees. This is extremely common. I would say most people pay at least 1% in fees. Suddenly, on that exact same example, you don't have 1.4 million in the future. You have 361,000 less. Nearly 25% of your wealth was destroyed by a 1% fee. Let's move over one column to 2%. You don't have 1.4 million. You have 600,000 less. Nearly 50% of your net worth was lost to a 2% fee. Think about that for a second. You've put up 100% of the money. You have taken 100% of the risk, but in that scenario, you almost split your wealth. To the untrained eye, people will look at that example of 2% and say, fantastic, they grew my wealth from 100,000 over 30 years to around 800,000, without understanding the 44%, the 600 grand that was creamed off of the top. And the third example, 3%, this is the nuclear option. It's rare that I see it, but I have seen it before. You would have lost nearly 60% of your wealth in the future to fees, 828,000. When I first heard this, when I learned this, it blew my mind. But it also didn't compute in my brain. How does 2% equal 50% in the future? Like my wires were getting crossed, my computer brain was like malfunctioning. So I'm going to explain exactly what's going on behind the scenes with the fees and why they are so damn deadly. So there are 3 things that are happening simultaneously. Number 1, fees make good years just not as good. Let's say you made 8% return on your investments. Great. Remember, you've lost 2% to fees, so your real return was 6%. Fees are taken on the entire investment pot, how much you have invested. not the profits you made that year. Very important distinction. So in this scenario, 25% of your gains were lost to fees. Now, fees are taken regardless if you make money or lose money. So fees make bad years even worse. So let's say you lost 8% one year. Tack on another 2% loss for fees, your real return was minus 10%. They make bad years even worse. So in this scenario, 25% was added to your losses through fees. And number 3, the final reason why fees are so deadly is the richer you get, the more fees that you pay. Remember that I said the fees are paid on the total amount that you have invested. So at the beginning, when you invested that $100,000 in the example, a 2% fee was $2,000 per year. But over 30 years, your money has grown, hopefully close to $1 million. You're still paying a 2% fee, but suddenly that's 10 times the price. $20,000 you are now paying in fees. Most people focus on what stocks they're picking and how much they invest and avoid the silent killer, which is fees. So my challenge to you is if you are already investing, either through a pension or just on your own, make sure you know what fees you're paying. Go visit the investment platform, download the fact sheets. It should be clearly displayed how much you are actually paying in fees. And don't forget to add them all up. It can be sometimes confusing to figure out, but it is well worth your time. Figure out how much you're paying in fees and see if it is worth it. If you're on the other side, you haven't invested yet and you're looking for some low-cost platforms, here's 3 cool ones. Some of them are international, some of them UK only. Vanguard is a great idea for low-cost index funds. It's more of a do-it-yourself kind of platform in the US and the UK. Wealthify, do it for me. Another sort of more techie company. You can do it on your phone, investing through your phone. Be careful here because they do it for you. There will be a higher fee. Also, they have ethical investing funds, which cost a lot more. So be careful. Notice the fees. And AJ Bell is somewhere in between. They're kind of a do-it-with-me type platform. You can go DIY. They have people there to help you. A bit of a hybrid model there. Regardless of what platform you pick, pay attention to the fees. Next up, the secret number 2. Nobody can predict the market. Nobody. And there's 2 main investing strategies when you start investing. There's a passive strategy and an active strategy. So a passive strategy is like those index funds, the S&P 500 example that I gave you earlier. Super low cost, as we can see, they're very cheap, 0.05 to 0.75%. Those are just rough guides of the costing of passive index funds. And they are a set and forget strategy. You buy and you hold them for as long as is humanly possible. And the goal of these passive funds is to mirror the average return of the market. The other side of the coin is an actively managed fund. And as it says on the tin, someone is actively managing it for you. They're more expensive because you have someone there doing it for you, and they are a buy and sell. They're trying to predict what's going to happen in the market to get you a better average return than the passive index fund you could easily set on autopilot and do yourself. Now, we've just learned the impact of fees. Take a look at the difference between the two. As I said, my passive investment cost me 0.1%. Some of the typical active fees are anywhere from 7 times to almost 19 times the price. So we're going to learn right here, is it worth it? So here's an example of a passive index fund, S&P 500, own the 500 largest companies in America. You can bank on an 8% return over the long term. Short term, sometimes it's higher, sometimes it's lower. Over a long period of time, 8%. An active managed fund, right? They're trying to pick the individual companies, the winners and losers, are trying to beat the average return of the market. So CNBC did a fantastic study to see what percentage of these professional active investors were beating the S&P 500 return of 8%. And 2019 marks the 9th consecutive year that the majority could not do it. In 2019, only 35% in that year of active investors could beat the return of 8% from the S&P 500. But remember, that is just 1 year, folks. We're going to be investing for much longer than 1 year. Let's see what the percentage of professional investors who could beat the market in a 15-year window. Okay, a lot lower. Only 8% could do it. But remember, investing is a lifetime sport. Many of you will be investing for the next 20, 30, 40, maybe even 50 years. So let's extend the window one more time like CNBC did. 30-year window. What percentage of professional investors do you think could beat the return of the S&P 500? 8%. Wow. Only 1% of professional investors could do this. That's the reason Warren Buffett and Ray Dalio, these are household names because they are the exception to the rule. They are the 1% who've been able to do it consistently over time. So it begs the question, why are you paying those high fees for underperformance? Keep that in mind. If no one can predict the market, when do you invest? How much? How often? When should you do it? These are all questions I hear all the time. So here's one strategy how you can try to avoid predicting or timing the market because no one can do it. So one way you could do that is dollar cost averaging. And this is a fancy way of saying regularly investing into the stock market over the course of the year. Maybe it's every month, maybe it's every quarter, but just regularly despite what's happening in the market. So in the top example, in the blue example there, that is someone who's invested a lump sum of $8,000 in January for 8 months in an index fund. As you can see, the price ping-pongs up and down over the course of those 8 months, and at the end, in August, it's back to a 10 share price. That person in the blue made 0 return on their money. The person in the orange had a different strategy. They didn't do the lump sum investing, they dollar cost averaged, meaning they put in 1,000 or invested 1,000 every month from January to August, 8 months. Exact same index fund that they invested in. And what do we notice after the 8 months? It's still where they started, but they made 4% over that 8 months. How did this happen? So the person who was dollar cost averaging in the orange was able to use price fluctuations to their advantage. They didn't care what the price was trading at on a month-to-month basis. They consistently invested over time and used the market to their advantage. So if the market was going up, fantastic, they made money. If the market was flat, fantastic, didn't lose money. And when the market dips down to $9, $8, or $7.5, they were able to buy their investments at a discount. And they understand how the stock market works, that over time, despite these short-term price fluctuations, over time, the market always recovers. And that is the third and final secret. The market always goes up, relentlessly up over time, despite many short-term setbacks. Individual stocks can fall forever, but the market as a whole always recovers. Take a look at this chart. The S&P 500, we've been using that as an example. Let's keep going from 1929 to 2019. What do you notice about this chart? There's 2 things that really stand out to me. Number 1 is how volatile it is in the short term, right? It's up and down all the time. The other thing that I notice is if you take a long-term view, a 10, 20, 30, 40-year view, it's quite predictably trending upwards over time. You can see that red dotted line, the long-term trend is relentlessly up. Think about everything that's happened during that time period. At the beginning, that massive crash there is the 1929 Great Depression, worst economic period in history. You can look in the 70s, there was the oil crisis. You look at 99 to 2000 dip, that was the dot-com bubble. And most recently, kind of the 2008 global housing recession, right? The market survived all of this. Wars, disease, crashes, inflation, everything that you threw at it. It survived, it recovered, and it trended upwards. Here's another example, the Dow Jones. This is another type of index. This tracks the 30 largest companies in America over a century of data. Again, what do you notice? Even more blatant, it's relentless pursuit upwards over time. Did it drop? Did it dip? Were there years you would have lost money? Absolutely. But if you take a long-term investing view, relentlessly upwards over time. There's reasons why this happens. And when you understand these 2 forces within the market, it can really help you get comfortable with investing. I'm going to walk through both right now. The first is there's a promotion and relegation system within the stock market. For those who know football, great. For those who don't, I'll break it down more. The worst performing companies are replaced by better performing ones. The market is essentially self-cleansing. Every so often, the stock market's reviewed and the worst performing companies are evaluated. And if they're not performing up to standard, they'll be removed from the stock market index and replaced with a fresh company who's on the way up. Fresh blood. So ExxonMobil's a great example. They were on the Dow Jones for 92 years, recently been replaced by Salesforce, who's barely 20 years old, right? A new tech software company. That's an example of the self-cleansing nature of the stock market. Deadwood out, fresh, new, great companies in. Think Facebook, Twitter, Uber, Amazon. All these companies didn't exist 30 years ago. In 30 years' time, there'll be another bunch of companies that are traded that don't currently exist. So Deadwood replaced with fresh blood. The second reason the market always goes up is because there's limited downside, but unlimited upside. Companies can absolutely lose 100% of their value. Think Blockbuster. You remember the movie rental company? They went bankrupt. If any money you had invested in just Blockbuster alone, you would have lost everything. Whereas there's no limited upside to companies. It's not like the maximum returns you can get are 100%. Netflix, for example, is a company that has returned 4,000% in the last decade. Just incredible. No limit to a company's upside. So think of these two things happening simultaneously. Dead companies out, fresh companies in, and those fresh companies that come into the index have no limit to the upside. That is why the market is continuously pushing up relentlessly. You'll see it in the news all the time. The Dow Jones, the S&P 500, new high, record-breaking high. This will happen all of the time because of these two forces at work. Now, if you invest in individual companies, it can be very risky, right? You could have invested your life savings in Blockbuster, you would now have nothing. The only way you would lose all your money in the S&P 500 is if no companies existed in America. If that happens, then like the aliens have invaded and like we're all screwed anyway. So don't worry about your portfolio. The media loves to prey on our emotions. Here's 3 Time magazine covers I love to show clients at some of the worst economic periods in history. 1929, Great Depression, 1974, oil crisis, and 2008. This is my favorite cover. London is sinking. This is where I live right now. They're saying the financial world is drowning. We will never recover. But guess what? We always do. So let's quickly review the 3 secrets every investor needs to know. Number 1, fees destroy your wealth. They are the silent killer. Keep them as low as possible. Number 2, nobody can predict the market. There's a great quote by Warren Buffett that says, by periodically investing in low-cost index funds, the know-nothing investor can beat most investing professionals. Dollar cost average, use it to your advantage. And number 3, the market always goes up. Avoid doomsday short-term news and invest for the long term. Master these 3 secrets and you will become a confident and resilient investor. Now, I want to show you how exactly these secrets, if implemented, can change your life. This is by far one of my favorite tools I use with clients, this investment calculator. Let's just say you started out with a very modest amount to invest, maybe $2,000. That's about it, dollars or pounds. You have 45 years to invest at an 8-year return, and you dollar cost average $200 a month into something like a low-cost index fund. Let's take a look at the results. There you go. Millionaire status in your lifetime. No big inheritance, no lottery tickets, just good investment principles you've used over the long term. You invested $100K over your lifetime and got back 9 times that, over $900,000. Maybe you don't have 35, you're not in your 20s, you don't have 45 years. What about 35 years? Same 8%, but maybe you have some more disposable income. Still millionaire status for you. Pretty incredible what some simple principles implemented today can produce down the line. Even if you go down to only 30 years to invest, again, you'll have to increase the amount that you invest, $750 per month, but you will still make it to that millionaire status. That is the power of learning this stuff as early as possible. Not just learning it, but implementing an investment strategy early on. But this is not about some pot of gold at the end of the rainbow. It's not about dying on a pile of cash and never enjoying it in the present. Just imagine I dropped $1,000 or pounds into your bank account tomorrow. What would that mean for you? For some, very little. For others, it would mean the world. What about $10,000 tomorrow into your account? Okay, bit more interesting. What about $100,000 into your account tomorrow? Suddenly your options are starting to expand. You can make that career change that you wanted to. You could spend more time at home with your kids. maybe just quit the job that you hate, take a sabbatical, something like that. What about £1 million or dollars into your account tomorrow? Game changer, right? Each stage of the wealth building process unlocked more ways for you to live your life on your own terms, not somebody else's. That is how you build your rich life. Meet Bryce and Christy, the youngest retirees in Canadian history. They built a large enough investment portfolio that they retired at 31 and now live off that and travel the world full time. Pretty amazing. Alan Donegan. He was able to build up an investment portfolio to escape the corporate rat race, and now he only works on projects that are extremely fun, rewarding, and that he loves. And finally, there's me. The power of investing has allowed me to demand higher raises at work, leave a career I found unfulfilling, start my own business debt-free, visit family and friends around the world, but most importantly, start living life on my own terms. So if you've made it this far, you're excited, you want to continue your investing journey, you want to know what's next or what now? Come and visit me, patrickvenn.com. I would love to hear from you. You can learn more about my one-on-one coaching program, the Personal Finance Bodyguard program, where I help you master your finances, invest with purpose, and crush your financial goals all within just 12 weeks. Whether it's optimizing your monthly expenses, investing, pensions, retirement, I would love to help you optimize your money and start building your version of a rich life. Together, we do one-on-one remote sessions, partners included at no extra cost, and I give you lifetime access to over a dozen custom tools, systems, and resources you can have for life to stay financially fit. I've brought enough clients through to see the results and see what impact it's had on theirs, so I'm confident it can do the same for you. Money doesn't buy you happiness, it buys you options, and you deserve to live your rich life, whatever that means to you, and I would love to be the one to show you how. So if you want to fast track your financial future, hit me up, patrickvenn.com or at patrickvenn on Instagram. I'd love to hear from you, and you can learn more about the program there. Thank you so much for tuning in. I appreciate your time and attention, and I hope this has been helpful to you. Take care.